Good morning, or good afternoon, or good evening, depending on where you are, or I guess when you're watching this. My name is Jay Shamba. I'm the co-director of the Institute for International Economic Policy, or IIEP, here at GW. We at IIEP are very pleased to be hosting this event on the IMF Global Financial Stability Report. We at IIEP have been partnering with the IMF for a number of years now, helping roll out different publications, including the WEO, and some regional reports, and now for the first time, the GFSR. So we're really excited about that. The IMF certainly does its own rollout of these publications. The idea of these meetings is really to provide an opportunity for the authors to explore in more depth what the analytical work behind these chapters, and to bring in a great conversation with some outside discussants. I'd like to thank Mavesh Qureshi of the IMF for leadership in making sure an event like this could happen. We're really excited to be here today. And especially I'd like to thank our discussants for doing the kind of heavy lift of reading these really terrific chapters and preparing some thoughts on them. IIEP is located at the Elliott School at GW and is a cross-school interdisciplinary research center at GW. IIEP aims to serve as kind of a catalyst for high-quality, multidisciplinary, nonpartisan research on policy issues surrounding economic globalization, and we interpret that mandate rather broadly, so it includes international finance, international trade, development, poverty studies, climate change, economic policy more broadly. We've also had a pretty big focus on both China's economy and India's economy. And so we've been really busy at IIEP, despite not being able to hold in-person events. We've had ongoing series on India's economy, China's economy, inequality, rethinking capitalism, and multidimensional poverty. You can find links to prior events on our YouTube channel, or you can go to our website to see upcoming events and past events. I'd like to really thank the student staff at IIEP, without whom nothing could take place, and also thank our operations manager, Kyle Renner, for his partnership and making sure everything can move along here. So without further ado, I want to get moving on to the terrific content we have. So we have two terrific chapter presentations, followed in each case by a discussant. So first up, we're going to talk about non-financial sector, loose financial conditions, rising leverage, and risks to macro financial stability, a very big and also very important topic. And Adolfo Barajas, who is a senior economist in the IMF's Monetary and Capital Markets Department, and who has been leading the work for the analytical chapters of the GFSR since 2017, will be presenting that chapter. And the discussant is Wenxin, who is an associate professor of finance and the FAMA faculty fellow at the University of Chicago Booth School of Business, and a faculty research fellow at the NBER. And so we're really excited to see the presentation and Wenxin's discussion. So I'll turn it over now to Adolfo.
Okay, thank you very much. First of all, we'd like to thank the IIEP for this wonderful opportunity to present our analytical work for the chapters, and we're looking forward to the discussion. The chapter gets written, and it's a very concise document, very compressed. But based on that, there's a lot of analytical work, and we're in the process of writing more academic papers with this academic work and with this analytical work in mind. So the comments and the discussion will be hugely valuable for us. So let me get started. Let me share the screen. All right, so this chapter deals with loose financial conditions, rising leverage, and risk to macro financial stability. So we begin with three major observations. First, there was a leverage buildup coming into 2019. So the decade following the global financial crisis was characterized by historically high levels and an increase in non-financial private sector leverage. And in part, this is related to prolonged accommodative monetary policy after the global financial crisis. During 2020, we saw further escalation, and there was strong policy support that was involved to prevent disruption to credit flows. So during COVID-19, we saw a further increase in non-financial sector leverage. So given that there's a literature that links high leverage and rapidly growing leverage to risks to financial stability, there's it implies an intertemporal trade-off that's facing policymakers in the sense that they would like to counteract the short-term and the short-term negative shocks, but at the same time, this could lead to downside risk down the road. So we ask, what are the implications of this leverage and the financial conditions for macro financial stability risk down the road? And we ask three essential empirical questions. One, how do financial conditions affect leverage? Second, what are the implications of leverage for financial stability? And given the last two questions, is there something we can do about it? Is there a set of policies that can help mitigate that intertemporal trade-off? And we point to macroprudential policies. And it's a forward-looking view. It's looking at possible risks that could arise in the future, and the idea is how to navigate out of the COVID-19 situation, heading towards a post-COVID-19 recovery. So essentially, after a quick introduction, we'll be briefly summarizing those three empirical questions. That'll be sections 2, 3, and 4, where we look at financial conditions and non-financial sector leverage. Then we look at macro financial implications of leverage and the possible role of macroprudential policy and that intertemporal trade-off. And then we'll conclude and give our main policy recommendations.
I'm good.
So the first stylized facts we want to point to have to do with this increase in leverage. So for both non-financial corporate and household leverage, we see increases in leverage over the decade following the global financial crisis. And essentially this was adding it all together, it's a 15 percentage point of GDP increase in leverage up to 2019 Q4. And then during 2020, we see a further increase of about 8 percentage points for non-financial corporate, about 4 percentage points for household. And some of this, of course, has to do with the collapse in GDP in many countries. But even taking that into account, there's been a buildup in leverage, and also related to policy support, which made it possible for cash-strapped households and firms to borrow during this time. Looking quickly at correlation. So here what we're looking at is financial conditions, and we're using an IMF constructed financial conditions index, which is a principal components aggregate index of about 10 indicators, price-related indicators of market spreads and equity markets and housing markets, and they summarize what could be called the price of risk as perceived by markets. So when price of risk is low, there's an incentive to take on debt, there's an incentive to borrow and lend. So here, very quickly, we took the FCI for different countries in our sample. We have a sample of 29 countries, 19 advanced, 10 emerging, and over the sample period that we're looking at is roughly from 1996 to the end of 2020, we look at financial conditions and the subsequent 12-month increase in leverage, and we find, by and large, a positive relationship, which motivates our analysis, both for non-financial corporations and for households. And also, just looking at correlations, we also see that when leverage growth tends to be high, so we take leverage growth over 8 quarters, and then we relate it to the subsequent 12-quarter increase in output, we also see a negative relationship. So there's something to this fragility or vulnerability that leverage buildups tend to lead to. So these are the two relationships that we're going to examine in a much more careful fashion using econometric analysis. So the main questions of our empirical analysis are: how do financial conditions affect leverage accumulation, and what are the macro-financial risk implications of leverage? And we're going to be doing this by sector, by country groups, over different horizons, and for different regimes. So we're going to separate episodes of particularly high or rapidly growing leverage. And we're going to do this last question, particularly for portions of the distribution. So we're very interested in downside risk, and this is the growth at risk approach. And the third question we ask is, what is the role for macroprudential policy? So if it is the case that leverage does lead to these macrofinancial risk implications, the downside risk, then can macroprudential policies do something about it? Can they lean against the wind? Can they reduce that downside risk? So putting our analysis in context, what's new about this? We're looking at leverage as an amplifier of risk there, and we're taking both non-financial corporate and household leverage. We're also looking at the role for both advanced economies and emerging markets, and we're assessing policies that are relevant in the current context. And we're using this growth at risk framework, and it's a very standard now tool that's used in the GFSR that helps us monitor financial stability risk. It was introduced in the October 2017 GFSR, but there are other applications such as house prices at risk in the April 2019 GFSR, and it builds on large and expanding literature on leverage. Just to name a couple of very prominent papers. One is Mian-Sufi and Werner, which concentrates on the effects of household leverage buildups, and Jorda et al. More recently looks at non-financial corporate leverage and the implications for downside. So let's look at that first question, on the first empirical question. And here, what we show is in a local projection framework where we have leverage growth as a dependent variable, and we have financial conditions as the main explanatory variable, and country-specific controls and time effects as well. What we see is that increases or greater looseness in financial conditions does accelerate the buildup of leverage of non-financial corporations and of households. And in particular, this relationship intensifies when the economy is in a credit boom. And we define credit boom in a way similar to other papers, where we take the eight quarter growth in leverage, and we combine that with relatively loose financial conditions when a country is above the 70th percentile in credit growth and has relatively loose financial conditions, loose below the median, then we find that this relationship intensifies. The loosening of financial conditions leads to even greater accumulation of non-financial sector leverage. So the main result here is, of course, that loose financial conditions are associated with increases in leverage. This holds true across types of sectors and country groups. And one result we didn't show, but that came out in the analysis, is that there's an asymmetry, and it tends to be stronger on the loosening than on the tightening side. And the effects of financial conditions on leverage are stronger during these credit boom episodes. And in the current context, this suggests that the effects of loose FCI are likely to be very strong for some economies. The second important empirical question is what is the relationship between leverage and macrofinancial stability. So taking the growth at risk framework, the idea is we look at an easing of financial conditions, and we estimate what the effect is, not on the median output growth over different horizons, but we focus on the downside risk. So here, what we're trying to predict is the 10th percentile growth impact of easing financial conditions. And this first panel shows the classic growth at risk intertemporal trade-off, where a easing of financial conditions will alleviate in the near term. So an increase means that the downside risk is alleviated, but at the cost of an accentuation of the downside risk over the medium term, starting at 8 or 9 quarters. And what we find is that this trade-off becomes more accentuated during credit booms. So the red line shows you that not only is the near term more, the attenuating effect is stronger. It goes from 1 to 2, but the downside risk is also stronger, going from 1 to 3. And we get this intensification, this amplification effect of rapidly increasing leverage under situations of loose financial conditions. They also find that leverage buildups themselves are conducive to greater downside risk. So both on the left-hand side, we have corporate leverage. On the right-hand side, we have household leverage. When leverage intensifies, when the growth rate increases, we see greater downside risk over the future. So the third question is, well, now that we know that there is this impact of financial conditions on leverage, and that leverage has this implication of intensifying the intertemporal trade-off, is there something that macroprudential policy can do? And first, we want to just show you types of measures that we're looking at for macroprudential policy. So here, this is taken from an IMF database of macroprudential actions, and there's 17 different measures, and they're placed into 7 different categories. And what we show here are simply actions of either tightening or loosening, and in each period, in each 5-year period, that we sum up and we find out if during that period there's been net tightening or net loosening. And what we see is starting in 2000, and particularly after the GFC, we see an intensification of tightening actions in macroprudential policy. And if you look at the far right and the last few bars, we see that the green areas is quite prominent. So capital measures tend to be very, very prominent, as well as liquidity measures, the red area. And this has to do with Basel III and regulations on banks, which tighten capital. But there are a lot of other measures that come into play. When we compare across advanced economies and emerging economies, the pattern is similar. Their capital and liquidity measures are more prominent, but a few differences arise. So, for example, for foreign exchange regulations, such as limits on open positions, are much more prominent in emerging economies than advanced economies. But a whole array of policies have been imposed in both groups. So what we do is, with these measures, and we'd like to point out that we're looking at actions, and it's very difficult to to measure the intensity of the action. So we take every tightening as roughly the same, and every loosening is the same. So what we're measuring is a net tightening. And so what we use is a categorical variable that takes in each period for each country a value of -1, 1, or 0. So 0 if there's no net tightening, 1 if there's a net tightening, and -1 if there's a net loosening. And what we find is that certain types of macroprudential measures do have an effect on leverage buildup. So borrower-based measures, and these are, for example, LTV and DSTI limits, these will tend to reduce the accumulation of leverage for households. And we see that the effect accumulates over time, and you get a lag for the full effect to come into play. For non-financial corporate leverage, we find that liquidity measures such as limits on the LCR, liquidity coverage ratio, or things like reserve requirements will also have an impact on the buildup of leverage for non-financial corporates. And in emerging economies, these limits on FX exposure, so the limits on foreign currency open positions and reserve requirements on foreign currency assets, these have an impact on non-financial corporates in emerging economies.
Adolfo, you've got about 3 minutes left.
Okay, so the last empirical result is to look at the intertemporal trade-offs. So what we do is, in the same framework as the growth at risk results we showed before, we just add a measure of overall macroprudential tightening. And the first panel on the left just shows us that it attenuates the downside risk over the medium term. So it takes about 10 quarters to really become significant, but it does attenuate the downside risk. And on the right side, we take the same growth at risk type of result that we had before, and we find that while macroprudential tightening in conjunction with financial conditions loosening has little significant effect in the near term, it does tend to attenuate or mitigate the downside risk in the medium term, say after 9 or 10 quarters ahead. So our main findings are, of course, the stylized fact of increasing leverage in the decade up to COVID-19, and then a further increase in 2020. Loosening financial conditions, we find, intensify buildups in leverage, and particularly when the economy is in the midst of a credit boom. And there's this intertemporal trade-off. Loosening financial conditions will improve the short term, but at the cost of greater downside risk. And this is amplified by a credit boom situation. And we find those three types of targeted macroprudential policies can contain the buildups in household leverage and in non-financial corporate leverage. And we also find that overall tightening can serve to mitigate that downside risk. So our policy recommendations are that in this post-COVID environment, there's a case for tightening macroprudential policies, but the timing will be very, very crucial and challenging. It's going to depend on country-specific circumstances, because what you don't want to do is have policies that tighten financial conditions, for example, prematurely, which will endanger the recovery. But given that there's a lag between the design and activation and the full impact of macropru measures, this makes a case for acting early on macroprudential. And another recommendation is that, by and large, the macropru tools available work through banking institutions. And we see financial intermediation migrating more and more away from banks. So there's a pressing need to develop macroprudential tools for non-banks. So I'll stop here and look forward to this discussion. Thank you.
Great, thanks so much. That was terrific. I want to turn it straight over to our discussant, Wenxin Du from the University of Chicago. Wenxin, the floor is yours. And also just to let people know, the chat will open up over the next few minutes, and if you've got questions, you can put them in the chat, and after the discussion, I'll bring those forward to the panelists.
Great, I'll get started. Thank you so much for your invitation to participate in this wonderful event. I very much enjoy reading this analytical chapter and the whole GFSR report dated April this year. So I'll first give you a quick summary of the key messages of this chapter. Then I will basically highlight a few perspectives that are somewhat mentioned but not thoroughly examined. I think that could be useful for ongoing or future work. Okay, so a key summary of the chapter is as follows. I think the chapter has three main results. The first, the chapter shows in a very systematic study that easy financial conditions led to buildups of excessive leverage. And why is this a problem? Because the chapters further demonstrates evidence that the high leverage today increases the downside risk to future growth. And finally, is there anything we can do about it? Yes, and the key is the macroprudential policy. So the chapter shows, again, through an analytical framework, in conjunction with this growth at risk model, that macroprudential policy can help mitigate the future downside risk to growth. So obviously, this is a very timely and important analysis. And the three different perspectives that I want to bring into the discussion today. First is, I think it will be useful to not just look at the level of the leverage, but also have more consideration about the composition of the leverage. And I'll show you one example about why maybe that would make it further interesting, the analysis. And second is I want us also to think about this interplay between a dynamic like global leverage cycle versus a leverage cycle that's more driven by local factors. And as you can imagine, the corresponding policy interaction and the prescriptions are going to be different depending on the nature of the global cycle. And thirdly, which is also mentioned at the end of the presentation, I would like to again highlight the more subdued role of the banking sector since the global financial crisis, in part due to the Basel III regulatory framework, and in the meanwhile, the rising importance of the non-bank financial institutions. Okay, so that's the plan for my discussion. So let's revisit the two key figures of this chapter, and then I'll go to talk about my comments. So in my view, this is the number one key finding from the chapter. So this contrasts two scenarios. One scenario is easy financial condition, but with no credit boom. So that's the green line. As you can see, in the short run, you get expansion of growth, and in the long run, you have a negative growth, right? And the standard error is pretty tight. So overall, you do have this baseline intertemporal trade-off. But the red line is showing if you have a lot more accommodative credit condition today, say you're inside a credit boom, then this intertemporal trade-off is exacerbated, right? In the short run, you get a larger expansion of growth, and in the long run, you go into this boom and bust cycle, which can be painful. So from a policymaker's perspective, we have to think about, is there anything we can do about this, given along the baseline, we think many policymakers are relatively myopic, right? They're not going to be willing to give up this short run gain, which their political futures might be very much hinges upon. And so if you just want to prescribe a policy, say we can improve the medium to long run perspective at some cost of the short run expansion, that may not be popular and may not be implemented. But the nice thing about this chapter is it does prescribe a policy that doesn't really give policymaker this particular trade-off to speak. They don't have necessarily to give up the short-term gain if the macroprudential policy is well targeted, well implemented to get rid of the so-called excessive leverage. Then there's no guarantee that in the short run you have to forfeit the gains. And the nice thing about this policy is that in the long run you can avoid the downside risk. So I think this is a very nice message to highlight from the chapter. Most of the empirical work on the impact of macroprudential policy doesn't necessarily make this point, right? It's either looking at outcomes that are very specific to the market they're targeting, or even thinking in the like growth context. There is oftentimes this trade-off between like sacrificing some short-term growth versus the long-run stability. But I think what this chapter really brings is maybe if the policy is very well designed to get rid of the extra saying leverage that you don't need and the risk taking, you don't necessarily need to compromise the short run economic gain. Okay, so that's the summary of the message from my take. And the first thing I want to say is this is a very, very timely chapter. Why do I say so? So this is taking a different set of financial condition index, not the IMF one, but the Bloomberg one, but the general message is very similar. What we see is that this time is different. This time is different in the sense the downside risk, I mean, to the financial condition is much lower, right? The financial condition took a deep dive in March 2020, but then recovered very, very quickly, thanks to this extraordinary coordinated actions by central banks and fiscal authorities around the world. In comparison to the much more prolonged recession or depth deep in the financial conditions around the GFC and also around the European debt crisis. For each of these two other episodes, the financial condition index was in negative territory, very negative territory for at least a year or two, whereas this time it's really just a couple of months. So in other words, we're already in the expansionary stage or in the credit boom, so to speak, for a very long time, even though the COVID March 2020 just seemed like yesterday. So I do think to think about these issues early is useful just because the recovery in financial condition is a lot faster this time around. Okay, so that's good. So that's what makes this report very, very useful. So as I mentioned in the introduction, the first perspective I would like the authors and the team to think more is regarding the composition of the leverage, not just the level of the leverage. So here I'm showing you a chart, which is all about composition because the level is fixed at 100%. This is taken from the Federal Reserve's financial stability report from last year. The new one is going to be coming up, I think, in a couple of weeks, where you see this very stark growth in the share of large institutional leverage loans issued by the riskiest firms. So the red line is the debt multiple with firms with debt to EBITDA ratios over 6 times. So this is to say, like, even if the overall leverage loan markets in terms of the total leverage taking might seem to be just in line with their historical norm or even somewhat subdued, if you look at the composition, you will get a different message, right? It seems like there could well be some froth in the market because now the riskier issuers account for the largest fractions of newly issued institutional leverage loans. So I don't know how feasible is it to do some similar exercise on the cross-country level, not necessarily for the leverage loan markets, but you can look at the corporate debt, look at the bank loan in general, and do some composition, bucketed issuers into different credit rating and size, and you can possibly repeat your analytical framework to see maybe it's the riskier segment that poses the highest downside risk in the future. So I think that would enrich the analysis by have a more thorough overview of the breakdown as opposed to just the level of the leverage. Okay, so that's the first comment. The second comment is regarding this global versus local financial cycle or leverage cycle overall. So what you can see is there is this very well-established literature at this point by Ellen Ray at LBS and co-authors where they show no matter whether you look at price-based measures, for instance, VIX, S&P return, emerging market sovereign spread, etc., versus some quantity-based measures such as cross-border cross-border flows like bank credit growth, etc., you get a very strong co-movement, a very strong common factor across different countries, and a very strong co-movements between the price-based and the quantity-based global factor. And the authors call these type of boom and bust fluctuation as global financial cycles, right? So in our context, thinking about financial stability and thinking about the leverage cycle, I think it's very important to also have a perspective. Is this cycle a mainly global cycle, or is this mainly a local cycle? And in the context of global cycle, the literature has labeled the US monetary policy as an important driver of the global cycle. So in terms of macroprudential policy, depending on the nature of these cycles, obviously different policy packets are required. When it comes to mitigate the global cycles, we're going to have to think about issues along the capital control measures, even to some extent. And that's where the definition, the boundary between macroprudential and capital control can potentially be discussed. And I think that will be very useful for policymakers to think about the nuanced differences. Okay, so that's the second thing I want to highlight. The third thing I want to highlight is, as you can clearly see from this chart, the banking sector has a much more subdued footprint in the overall economy post-global financial crisis. You can argue this is due to the macroprudential policy if you consider bank regulation as part of the overall macroprudential toolkit. So why do I say so? If you look at the asset growth, so this is plotting the total assets of US commercial banks relative to GDP, it's largely stagnant post-global financial crisis. You get a large boost during the peak of COVID, in part due to large injection of central bank reserves as part of this expanded QE programs. And even more starkly, if you look at the asset in terms of GDP, percent of GDP for the broker-dealer sector, so these are the traditional intermediary, sort of most important intermediaries of the capital markets. I mean, the broker-dealers asset to GDP has really shrunk unambiguously. So then meanwhile, if you think about the provider of capital, if they're not coming from the banking sector, non-bank financial institutions, so here I'm only plotting one large component, for instance, the growth of the mutual fund industry has been fairly sizable, right? Like it's basically coming from like 40% of GDP right after the crisis to now like close to 90% of the GDP as a conservative estimates. So as the author and in the report and also at the end of presentation mentioned, this really poses a significant challenge to the implementation of the macroprudential policy. And even to some extent, cast some doubt on the validity of these results going forward, right? Because the past results in terms of effects of macroprudential policy, it's pretty much centered around like a very significant and sizable banking sector. If that assumption is not going to hold in the future, if the banking sector continue to play a more subdued role, then we really have to sort of think about how to expand our toolkit and to address the developed tools to address the inherent vulnerability associated with the non-bank financial institutions. I think I'm probably running out of time, and I'll just end up here. And again, it was a very great chapter, and I look forward to the Q&As. Thanks so much.
Great, thanks so much, Wenxin. I want to turn it back over to Adolfo for a second for any reactions, and maybe just point him to, because I was curious, I was also struck by one of the things Wenxin pointed out, which is it feels like you're pointing at almost a free lunch, right? Which is that you can put in place, good macroprudential policy seems like it doesn't take away any of the positive growth sides of things, but it does mitigate the downside. And I was curious if that was true beyond the 10th percentile outcomes, if it was a more broad result, because it's a really interesting one. But also just to give you time to react to any of Wenxin's comments.
Okay, so how much time do I have for?
If you want to just take a few minutes for that, and then we can keep asking questions after.
Okay. First of all, thank you, Wenxin. Very, very, very relevant, very, very good comments. I would say on the first point about the free lunch, Yes, it appears to be so when you look at the 10th percentile, but for many results we get on the median. So you don't sacrifice on the 10th percentile, but you do sacrifice on the median growth. And the other thing to take into account is possibly these subdued short-term effects have to do with the lag. So it takes a while to kick in. And so that's why we emphasize the message that act early, because there's a lag for these to really start affecting downside risk. On the composition of leverage, I think, Wenxin, you make an excellent point that it's not just the quantity, but the composition. And in the back of our minds, what we think is that when aggregate leverage is increasing very rapidly, there's a composition towards riskier borrowers. But that would be something very, very interesting to investigate. And for our broad sample, that might not be possible, but we could resort to there was a previous GFSR that looked precisely at the riskiness of credit allocation, and we could ask this question to see to what extent do these credit booms, do these rapid increases in credit correspond to episodes where the composition gets riskier, and we have a measure that can track that. Not necessarily for all the countries, but for a subset. On global versus domestic leverage cycles, yes, I agree. There's an issue that we don't make explicit. We control for global factors because we have time effects in all of our regressions, but we don't explicitly separate what part of the increases in leverage are global and what part are domestic. One thing that surprised us a bit is that we ran the leverage regression with different versions of financial conditions. We took global financial conditions, we took domestic, we took things like the VIX, so different measures. And what we found was that local financial conditions played a much stronger role. So if we had local and global or even regional financial conditions index, we found that the local dominated. In many cases, the global financial conditions would be not significant. But I agree that it would enrich the analysis if we separated and showed how much of these cycles are domestic and how much are global. And on your last point, I agree completely that our results are dependent on a time series during which banks still had a prominent role, but probably going forward, you might see a weakening in the effects of macro-pru on this. So to reiterate our point that we need, there's a need to develop macroprudential tools beyond the banking sector. So I think these are all very, very important points. Thank you very much.
Great, thanks. One question from the chat kind of picks up on that last point, which is asking maybe a little outside the research and more just forward-looking. As you see new developments, whether it's the kind of SPACs or central bank digital currencies or a rise in digital assets and things like this, to what extent do you think that will further this issue, where the macro-pru policies targeted at the banking sector really just won't kind of do what we want them to do because there's so much activity taking place outside? Or do you think, especially some of these newer things, just aren't really that big an issue yet?
Well, to the extent that they promote and facilitate the acquisition of debt, I think there's definitely an implication that macro-pru will not be capturing these innovations. But that's an open question. To what extent is this leading towards greater ability to borrow by agents outside those that would normally be financed by markets and banks?
I guess to kind of wrap up this session, then I'd be curious, either from you, Adolfo, or you, Wenxin, are there macro-pru related policies, one of the questions in the chat, aimed at non-banking sector leverage that we think could be effective? Are we seeing tools used in at least various countries targeting those sectors, or at least ways they connect to the banking industry that you do think show some promise?
I think there's some indication. I believe Korea is experimenting with some non-bank macro-pru measures. I'm not that familiar with that, but yes, I think there's some development along those lines.
Yeah, and also speaking of sort of tradition, right? We always had like a pretty elaborate regulatory frameworks for non-bank financial institutions such as pension insurance, right? So there are examples which are non-banks, a large sector part of the GDP that we are actually put them in the regulatory radar. But it's the newer things where that's the challenge, and that's likely to be most of the actions are going to be.
Well, great. That was a terrific session. I want to thank both of you for keeping to the time and for providing so much insights to the audience. I want to turn now to the second part of today, which is talking about commercial real estate, financial stability risks during the COVID-19 crisis and beyond. And we have Andrea Deghi, who is a financial sector expert in the Global Financial Stability Analysis Division of the IMF and the Capital Markets Department. And he is going to present that chapter, and then we will have Tony Yezer, who is a GWU economics professor and an IEP faculty affiliate, who will provide the discussion. So, Andrea, I'd like to turn it over now to you.
Thanks a lot, Jay. Let me start sharing the screen first. So hello, everyone, and many thanks again for the opportunity to present the findings of Chapter 3 of the GFSR today. So as just introduced by Jay, this chapter, we consider commercial real estate market and the focus in particular on the financial stability risk that are emerging potentially from this sector going forward. So first of all, why it is important to look at commercial real estate. So one of the reasons that commercial real estate has been one of the sectors that has been hardest hit by the COVID-19 pandemic. So historically, CRE has also been highly procyclical, and the large price swings that are happening in the sector are often also accompanied by financial crises, usually most often because of the concentrated exposures of banks and other investors. Another factor to consider is also that the pandemic in general could amplify the structural shifts that were already occurring in the market, such as the increase in digitalization, the use of e-commerce, and also working from home policies, which could reduce, in principle, the demand for certain types of commercial real estate spaces, and also increase the valuation of uncertainty going forward. So first, to understand the extent of the losses due to COVID, we can look, for example, at the volume of transactions. So in the first panel here, what we can see is the change in CRE transactions volume in 2020 Q2 and 2020 Q3 relative to the previous year. What we find is that transactions indeed fell across the board in all the global regions, and that the nature of the shock was also quite heterogeneous across different CRE segments. So as the middle panel shows, indeed, the retail and hotels were registering the largest decline in income, which translated also into large drops in CRE valuations for this sector, both for the US and Europe. Another element to consider is that not all the segments of the market entered into the pandemic in the same way. So in particular, the retail sector was basically already very weak with, in 2019, global total return, which was nearly zero. This was likely reflecting already the decreased demand for example, traditional brick and mortar type of businesses. It is also important to look in this context at delinquency rates in CMBS markets, which are a relevant source of funding in certain countries. And as you can see in the last panel on the right, the delinquency rates basically increased substantially during the pandemic. With, again, sectors such as retail and hotels that are reaching basically all-time highs. Compared to the previous pandemics, COVID-19 has also been unique in its global reach, and also the public response that it has produced. So when looking, for example, at the quarterly price changes across 64 large cities in 11 economies, which are shown here in the map, then what we find is that there is a considerable geographic heterogeneity in the performance of the CRE sector in the aftermath of the pandemic. So the colors here in the map are used also to indicate the extent of the CRE price changes, with red markers in general indicating the cities with the largest price declines. So overall, the CRE prices, what we find is that they fell the most in Winnipeg and Victoria in Canada, with price declines of 5% and 4.3% respectively in the second quarter of 2020. Whereas the CRE prices in certain global cities such as Paris and Tokyo, which are indicated here in green, seem to have instead held up quite well, at least for in Q2. So to limit the spread of the virus, then governments across the world have instituted, of course, containment measures. So as these measures can impact, in principle, income and vacancy rates of CRE properties, we would expect in general that the declines in CRE prices to be higher when with more stringent lockdowns and with less government support. So we can see simply this by plotting the median price change in 2020 Q2 for cities with high and the low stringency measures here in the green, and the median price change for cities with high and low fiscal support here in the blue. So as you can see from the graphs, basically CRE prices in cities with high lockdowns measures and low fiscal support have been the most affected by the pandemic, with the difference in impact, which is economically and statistically significant. So we need also to pay close attention to larger CRE price declines because they have led to significant losses for the financial system in the past. So in the left chart, we plot in this regard the losses in CMBS and CRE loans for the US and UK during the recent downturns. So during the GFC, for example, the loss rate for the CRE loans in the United States was about 8%. And in comparison to the GFC, also the recent agency projections about the COVID crisis, which are here in blue, have shown losses of basically similar magnitudes. So in general, these losses are also associated with an increased likelihood for bank failures. So in the right panel, you can see this by simply tracing out the overall commercial bank failure rate in the US in the red dashed line, and compare them with the failure rates for the commercial banks with high levels of CRE concentrations, the solid green line. So what we find is that in general, failure rates for banks with high levels of CRE exposures were basically 3-4 times higher than those on average. So against this background, we believe that there are three main channels through which CRE can have relevant application for financial stability, and those are described here in this diagram. So the first one goes for banks, and it relies on the fact that banks have substantial exposure to the market, both in terms of CMBS and CRE loans. The second channel instead is the collateral channel, which relies on the fact that a significant fraction of the non-financial corporates use commercial real estate properties as a collateral for borrowings. Hence, lower property valuations would also imply basically a lower borrowing capacity for firms. Finally, there is what we find a non-bank channel, which instead operates through the significant exposures that the non-bank financial institutions have in CRE debt and equity, in the specific context of commercial real estate, for both for foreign and domestic. Important to note is also that shocks can initiate a fire sale mechanism through these channels, which could, in principle, amplify also the losses from the initial shock. Then what we do is to bring our conceptual framework to the data and try to shed light on what are the macro-financial effects of CRE price movements. So first, we look at how CRE markets have evolved in the last decades. Second, we provide an analytical framework to understand the extent to which CRE prices are reflected in macroeconomic fundamentals. We then link to implications of such CRE vulnerabilities for the broader economy, and then with an assessment on whether macroeconomic and macroprudential policies could help to mitigate the tail risk in CRE. So we can start looking at how CRE markets have evolved over the past 2 decades. So as you can see in the left panel, CRE prices have risen substantially in the recent years. For example, in Sweden and the United States, CRE valuations more than doubled between 2009 and 2019. As for the composition of CRE debt, commercial banks still hold 70% of CRE debt in Europe and Asia, and basically more than half in North America, as you can see in the middle chart. Another important element to consider is also the presence of foreign investors. Indeed, the cross-border capital flows to CRE have increased since the global financial crisis. And what we noted is that most cross-border flows originate also from institutional investors. So these are deep-pocketed entities which comprise primarily pension funds and insurance companies, which have been growing in size over the years and maybe in general more prone to flights to safety when facing, for example, large global shocks. In fact, what we see in the data is that the higher the average share of cross-border investments in the pre-pandemic period, the greater was the contraction in total CRE acquisition volumes over the first 3 quarters of 2020. So the next step is to understand to which extent the CRE prices reflect the macroeconomic fundamentals. So this is of primary importance because it determines in turn the size of the potential price shock. A commonly used measure of CRE overvaluation is through capitalization rates, which is the ratio between the rental income and the value of the property. So as you can see in the left chart, capitalization rates have basically fallen to the lowest level in the recent decades, which could hint in principle to a price correction going forward. So, however, what we know is that the real capitalization rates as a spread instead of the government bond yields, which are shown in this case in the right chart, are not actually that different from the levels of 2009-2010, reflecting possibly instead the persistence of an illiquidity premium that investors instead continued to apply on real estate investments. So since these 2 standard measures suggest quite a different evolution of prices the last decade, so whether CRE markets have become more overvalued or not remains still an open question. So an important contribution of the chapter is then to provide a new tool for monitoring price vulnerabilities in this sector. So we model CRE in general, CRE valuations as a function of the expected income of the property and the return of holding the property itself using the so-called Campbell Shiller decomposition. In the underlying structural framework, we also control for other economic factors that could affect CRE valuation, such as output gap, inflation, money supply, and interest rates. And based on our model prediction, we can then determine what is the misalignment of the current market valuations from the value which is instead implied by economic fundamentals, which is a more structural measure of overvaluation than existing measures. So we plotted model prediction for 11 economies in both the pre-GFC period in the first panel and for the pre-pandemic period instead in the second panel. So what we notice is that first, price misalignment were intuitively, as expected, positive and large between 2006 and 2007 for most economies. So implying that CRE properties were overall overvalued before the GFC. The second panel instead shows that CRE prices had not been actually mispriced significantly before the COVID-19 pandemic, and that the value actually of the valuation was not statistically different from zero. So, however, when we look at the most recent developments, our model shows that the CRE overvaluations basically spiked up during the COVID-19 crisis, as you can see from the right graph. And this was likely due to the deterioration of macroeconomic fundamentals. So to understand which macroeconomic fundamentals contributes then to the valuation, we carry out an historical decomposition of CRE valuation. So this left chart shows in particular the case for the United States, where each color represents the contribution from a different factor, and the black line in this case is the trended level of price. So according to the composition, CRE prices are in general mostly driven by aggregate demand shocks, which are represented in this case by the dark green bar in the charts. And as expected, we find that in 2022, unconventional monetary policy are, as in this case, proxied by the ratio of broad money to GDP, helped to alleviate basically the downward pressure on fair prices. So nevertheless, the demand shock with COVID-19 was, of course, very significant. And what we observed was also larger than the drop in market prices, which basically ended up in increasing the misalignments in 2020 Q2. This evaluation could, in principle, imply substantial downward pressure on series prices going forward, especially if structural shifts toward e-commerce and teleworking continue to accelerate. So we acknowledge, of course, that there is still large uncertainty around the series market outlook going forward. But in the chapter, we attempt to examine the effect of shifts in series demand of fair prices using instead scenario analysis. So the last panel shows, the last panel shows in particular the impulse response of series fair prices against sustained increase in vacancy rates in our model. And the findings suggest that while the size of the impact of it varies, of course, across economies, a permanent increase in the vacancy rate of 5 percentage points would basically result in a median drop in fair values of about 15% after 5 years. So given these findings, we next assess the relevance of different macro-financial channels through which series prices shocks may affect financial stability. Series evaluations, again, and a subsequent drop in valuations could have serious economic implications. So to understand this transitional channel, we first therefore study the effect of series price evaluation on GDP downside risk with a standard growth at risk specification, which is very similar to the one that Adolfo just presented for the other chapter. But in this case, that includes also a measure of series price misalignment. So the empirical findings in general confirm that larger series price misalignments are in general associated with larger downside risk to GDP growth for both advanced economies, as in the left panel, and also in emerging market economies, as in the right-hand side panel. So quantitatively, just to give you an idea of the magnitudes, a 1 standard deviation increase in series price misalignment is in general associated with a 0.5% increase in GDP downside risk, 1 quarter ahead in advanced economies, and the effect actually remains statistically significant also for the following quarters. In emerging market economies, instead, the response of growth at risk is also significant in the medium term, but more contained. So now we turn then to study in detail the transmission channel through which series prices shocks might have a systemic impact on the financial system and the economy. The first one, the first channel is the bank solvency channel, which, as mentioned earlier, operates through the large exposures of banks to the market, both in terms of CMBS, for example, and the CRE loans. Intuitively, so a decline in series prices can cause a deterioration in the quality of banks' loan portfolios, credit losses, which could reduce in turn bank revenues and also their capital adequacy. So in order to quantify this channel, we need, however, a detailed bank level data, such as bank level series loans exposures and location specific series prices. So as these are in general publicly available only for the US, for this part of the analysis, we consider the US as a case study, but the results could also be generalized to other economies which have a similar degree of banks exposures. In total, we cover.
I just want to let you've got about 5 minutes left.
Yeah, thank you. So here what we show is the impact of a 16% drop in series prices over 8 quarters for banks with higher series exposures. So the coefficient basically alpha K in the baseline specifications, looking for different measures of bank performance. So on the left panel, we show the effect on series NPL ratio and series loan charge-offs rate, while in the red panel on the pre-provision net revenues and the total regulatory capital, where solid bars indicate whether that the coefficients are statistically significant at 10% or level or lower. So overall, the results are in line with our intuition and suggest that the series exposed bank experienced in general significantly lower performance for all the metrics considered. And just to give you an idea of the magnitudes following a 16% decline in local commercial real estate prices, we find that a cumulative 2.5 percentage points increase in the net charge-offs rate of commercial real estate loans, 12% drop in net revenues before provisioning, as well as a 4.9% decline in total recorded capital. So with this model and estimated coefficients, we then next conduct a stress test scenario. So we assume a different CRE price scenario, and in particular examine how bank capital could be affected. Specifically, two price scenarios are considered: a mild adverse scenario corresponding to a cumulative 16% decline over 8 quarters, and an alternative scenarios where we assume, similarly for the fair value model valuation, a permanent 5 percentage points increase in CRE vacancy rates, which implies, according to, again, to the valuation model, about a 30% decline in CRE prices in the long run. So given the price scenarios, we then take the estimated coefficient from the previous exercises and compute the sum of revenue losses and the cumulative provision expenses in terms of initial total risk-weighted assets. So this is, of course, not a full top-down stress test. So our main focus here is rather to study what is the marginal impact of a decline in CRE prices on bank capital adequacy through bank CRE loan exposure, therefore with conditioning on a given macroeconomic scenario. So in the panel, what we show is that also the distribution in the middle of 8 quarters ahead projected capital losses under the mild adverse scenario, reporting the percentage of banks that are small, medium-sized, and large, and the percentage of community and non-community banks for different levels of capital losses. So in general, we observe that a greater share of small or geographically concentrated community banks in the US are the ones that are facing potentially the larger capital losses under these scenarios. So the estimated losses related to the bank's risk-weighted value before the shock are, however, in general moderate. So with on average 14 basis points of risk-weighted assets. But there are, however, but there can be greater than 1 percentage point for banks with very high commercial real estate exposures, plotted for like it's plotted in the last panel with the blue line. We find also that a structural shift in CRE market could induce, which induces, as discussed earlier, a further decline in demand, would imply, on top of this, larger bank capital losses. For example, if vacancy rates permanently increase by 5 percentage points, the impact on bank capital would be actually about twice as large as indicated by the green line. So overall, these results confirm basically a significant transmission channel from commercial real estate prices to bank capital, which in turn could undermine financial stability. So we next study a related but more indirect transmission channel, the collateral channel. So we start by observing that the commercial real estate holding of non-financial corporations across our economies is normally used as a collateral in firms' borrowing and represent also a sizable share of the firm's balance sheet for both advanced economies and emerging markets, as plotted in the first graph. And therefore, it's possible that changes in the market value of firms' real estate holdings could affect the firm's investment expenditures significantly in a stress event. So to test this hypothesis, what we do is to use a granular firm level data, which spans 24 AEs and EMs. And the empirical strategy basically exploits two sources of identification. So the first one comes from the comparison within a local area of the sensitivity of investment to real estate prices across firms with a different level of real estate holdings. And the second one comes from the comparison of investment by land holding firms across areas with different variations in real estate prices. So our focus variable in this case is in bold in the specification above the graphs and represent basically the market value of real estate assets. So a positive and significant beta, so our coefficient of interest, would imply an increase in the market value of real estate assets leading to a higher investment. So the results are shown on the right panel. So in line with our working hypothesis, investment is significantly.
Andrea, I think your a bit over time at this point. I don't know if you can try to start to wrap things up so we have time for a discussion.
Sure. So, so the results are, just to wrap up quickly about the transmission channels. So in line with our working hypothesis, we find that there is significant sensitivity changes to series prices based on a different level of real estate loans. I will pass directly on. So an important final questions that we take over with the chapter is whether then macrofinancial policy can, what can do to help mitigate risk in CRE markets. So what we do is in particular indicate how macroprudential and capital management measures affect the downside risk of CRE prices. So among macroprudential measures, an important distinction can be made between CRE targeted measures and broader board-based measures, which indirectly affect CRE. What we find, I will jump directly on the results, is that when we look, for example, the effect of a tightening of such measure on the downside risk to CRE prices, which in this case is captured by the 50th percentile of the distribution of future CRE prices change using a quantile regression of different time horizon, we can see that basically macroprudential policies have indeed an important role in curtailing commercial real estate sector vulnerabilities. So specifically, tighter target measures reduce downside risk to commercial real estate prices by 0.26 percentage point a quarter in the near term, while broader border-based measures also tend to have a significant impact, but with tightening, reducing downside risk to CRE prices mostly in the medium longer term, as shown in the right chart. As previously mentioned, also the analysis looks at the effects of restrictions of capital flows. The result shows, again, that such measures are also associated with lower downside risk in commercial real estate prices. However, worth it to note that the use of capital flow measures to address financial stability risk should be considered only under specific circumstances, mostly when during capital inflow, for example, capital inflow surges, or when other policy options are limited, or the timing in this case is crucial. So to conclude, we saw that the commercial real estate sector has been severely affected by COVID-19 crisis. So overall, the large size of the sector and its heavy reliance on debt funding, as well as a strong interconnectedness with the real economy, make this sector highly relevant to domestic macrofinancial stability. So with these premises, the chapter, what we do is to attempt to identify and quantify the financial stability risk that would arise from the commercial real estate market going forward. So first, using a novel valuation model, we first show how CRE pricing misalignments have increased, in particular during the pandemic, following a deterioration of the macroeconomic fundamentals, which is of primary importance as we've shown, misalignments can exacerbate downside risk to GDP growth. And we also show that an adverse shock to CRE prices can affect negative macrofinancial outcomes through a weakening of bank soundness and decline in corporate investment. So in terms of policy recommendations, so the current conjuncture recommendations are that continued policy support, of course, remains warranted to stimulate aggregate demand and the recovery in the sector. However, easy financial conditions and also, as mentioned, the structural changes in the market could fuel potentially the increase in financial vulnerabilities and in turn lead to large and persistent price misalignment. So if such conditions are realized, then this would require the swift deployment of targeted macroprudential policy tools to address the buildup of vulnerabilities in the CRE, including those arising from non-bank financial institutions. I will stop here.
Great, thanks very much. I want to turn it over now to Tony Yezer and just remind people that if you have questions, you can put them in the chat. Tony, the floor is yours.
All right, actually a couple of disclaimers. So nothing I say reflects the opinions of the Consumer Financial Protection Bureau. The other thing is, you know, as a real estate economist, I always tell my students that I pretty well know how to get in to a recession. I have no idea how to prevent it or how to get out of it. Okay, so some of you may want to stop listening to what I have to say based on that disclaimer. I mean, you know, our big problem with real estate is we got a huge time to build technology, right? And of course, we've got, you know, Kidlin and Prescott. Well, Adam Smith knew you had a natural hog cycle in real estate that was going to cause it to be a problem. So having said that, I'm not going to review the paper because it was so comprehensive. So there's so much going on that I have no time to do that at all. Whenever we're talking about real estate, though, I want to put in some warnings here. We're really talking about investable real estate, which is about $50 trillion. Of course, that's obviously a fraction of $300 trillion worldwide. The data collection tends to be concentrated basically because we tend to collect data on the real estate that people want to invest in, and that tends to be concentrated. So when you look at the data, you have to watch out, right? Half of the investable real estate in Asia is concentrated in 5 cities. Okay. The private sector does real good work on investable real estate, but they don't collect information on the rest of real estate. And it would be really swell if international agencies would get into the process of expanding the data collection on real estate. That's a little advertisement. Okay, so first let's make sure everybody knows what a cap rate is. Cap rate is the rental yield on a property. It's net operating income over value. And of course, the dividend pricing hypothesis tells us total yield is equal to the rental yield reflected in the cap rate and the appreciation yield. Excuse me. It's determined by that total yield requirement, obviously determined by yields on competing assets. So cap rates are going to be low whenever monetary policy forces rates on government debt to be low. Low cap rates are the product of government monetary policy, right? And we see that in the paper, okay? So obviously your spreads with regard to government debt tend to be fairly stable, which is swell, okay? But we want to keep that in mind, the fact that if fluctuating cap rates are a problem, then discretionary monetary policy is a problem. Okay, will cap rates rise? And the answer is cap rates and interest rates are both mean reverting, so both will rise. Absolutely, I agree with it, okay? We have if you have historically low cap rates and cap rates are mean reverting, they have to rise. However, why do cap rates move? Is it because rents change or asset prices? Well, asset prices are much more volatile than rents. Now, we have an unusual experiment with the pandemic that rents have gotten pretty volatile in some of these sectors. But historically, okay, I mean, looking forward, it's the asset price where most of the volatility is rather than the rent. Looking forward, okay, what's going to cause cap rates to rise? Well, I would say that it's interesting. The chapter contemplates that rents will fall, and that's going to mean that asset prices will really have to fall much faster in order to raise these cap rates. Well, and that certainly could happen, right? In the model, as nearly as I could tell, an exogenous rise in vacancy rates was imposed. All right. Unfortunately, a lot of my material comes from private sector capital advisors who will not allow me to share it. But I can tell you what they're telling their clients, and that is that new rent contracts are down significantly in the US, but not so much in Europe and Asia. So perhaps we'll have more of a rent fall in the US than in Europe or Asia. Although that's backward looking, it could be going forward that the fall in new rent contracts will stop in the US. It certainly matters why cap rates change, okay? I mean, that's important. Where cap rates are falling, the debt coverage ratio could be driven less than 1. When the debt coverage ratio falls below 1, we really have a problem, right? The thing is, location really matters for what's happening in these markets. And the difficulty is all the discussion here, as well, by the way, and even more if you listen to the private sector, is by sector, not by location. Look, in the short run, hotel properties have been devastated. I mean, we got hotels that have no revenue because they have no guests in the hotel. I mean, you know, once the occupancy rate goes below 20%, you close a hotel. So that's certainly a disaster, but that's probably not permanent, right? Retail is a problem area, and certainly some properties are no longer viable. On the other hand, if you've got retail in, let's say, malls, malls often involve land values which are actually larger than the value of the mall, and so they can be repurposed. But again, that's location specific as a problem. Other categories of commercial real estate, office, yeah, it's been hit, but those are longer term leases, and the private projections have that within 3 to 4 years, net rental income of office properties will be restored to the current level. Again, that's usually for the US, but that's what they're saying. One of the things that's going to happen in office is the trend to crowd workers will reverse, and I think the word is decongest in the literature. By the way, industrial is doing really well, and other is doing really well. Okay, so when we look at what's likely to happen to cap rates and why, yeah, we really worry if well, of course, we worry if rents are falling and our debt coverage ratio is a problem, but that's location specific and it's also sector specific. So it is concentrated. By the way, let's take a look at residential. I don't know if people have seen this, but residential real estate is going gangbusters. Okay, this is a very new chart from FHFA. They don't have, besides it was done by my former students, so they can't prevent me from showing that. Okay, so I did my informal survey of what was happening. REIT stocks have recovered, and the industrial REITs are doing best. Real estate investment firms have recovered. Major hotel chains have recovered. I think possibly because they have properties that are dispersed across high and low risk markets, and also because some of their properties have tremendous land value. Even bricks and mortar retailer stocks have not done terribly. So you can ask, is this the time to lower LTV limits and raise debt coverage ratios as a discretionary policy? Well, I really worry about macroeconomics and real estate. The old saying, my head is in the oven, my feet are in the freezer, so on average, my body temperature is normal. Unfortunately, I am dead. The difficulty is that national averages are kind of meaningless for real estate, right? The other thing about real estate is there's persistence in both rates of change in value and rents. And so that areas in long-term decline are in long-term decline, and the areas that are growing are growing. And lending in these two types of areas kind of should be treated very differently. Setting a national standard for LTV and debt coverage ratio makes about as much sense as, and now I'll give my soapbox. I mean, now, hey, we require the government-sponsored enterprises to grant mortgages at the same interest rate in every market. That's macroprudential policy by our government. It's completely nuts, right? You want to know what that policy did to encourage the last housing crisis? Oh, it meant that the natural function of rising real estates to cut off the rise in real estate prices in the sand states was attenuated because the GSEs couldn't price regional risk. Then if we go to outfits like FHA, I mean, my God, their mortgage limits are pro-cyclical, right? So when we say that government can engage in macroprudential policy, maybe the first thing we should worry about is all of the policies that the government has that make no sense at all and that encourage real estate cycles, okay? Yeah, the other thing is, I mean, right now to slap a bunch of regulations, I think would be dysfunctional. Okay, commercial real estate investment is generally pretty smart. I think developers need to be constrained by the banking system. In the case of the US, they have, though. I mean, if you look at new starts and, you know, you look at new commercial activity, that's really fallen. It hasn't fallen so much in Europe and Asia. So I wonder what's going on there. To give a pat on the back to commercial real estate, in the recovery from 2008, 2009, private single-family rental real estate investment saved the day by buying up all the foreclosed properties. Today, with rising house prices, private single-family rental is dead as a CRE category. So this is a case in which CRE,
Tony, we're just about out of time.
Flexible and nimble and do some good for us. So
Tony, we're just about out of time. I don't know how much you have left.
No.
Okay.
Okay. The last point I'm trying to make is, there's an interesting problem here that I honestly do not understand in real estate finance. Okay, and that is that leverage risk should be priced. If leverage risk is priced, then the debt coverage ratio on the loan should become unviable. So the market should take care of itself if we are pricing real estate debt properly. Perhaps we're not pricing real estate debt properly, okay? Because surely leverage risk, unless there's regulatory capital arbitrage and these clowns are getting away with a difference between what they should be doing with interest rates and what they're actually doing. But the point is, just in simple economics, this should all take care of itself if interest rates are moving properly to price leverage risk. That's it. Thanks.
Great. We don't have a ton of time left. I want to give Andrea a chance to sum up or respond to some of Tony's thoughts. And maybe I'll just, in the interest of time, toss in, I'd say, some of the questions from the chat centered around a similar spot, which was, how much can we really learn from past cycles when we're talking about this pandemic one? You know, in the sense that it seems like in some markets, both local markets, as Tony's pointing out, or even in some countries, possibly the US, you might see a faster bounce in some of these prices. And so maybe things will just look different this time. And similarly, on the question of kind of regulating ex ante, could you really have done macro regulation ex ante before a pandemic crisis, for example, because you obviously don't know it's coming. So just if any of those thoughts work into your replies to Tony. Thanks. Andrea, go ahead.
Thank you, Jay, and thank you, Tony, for all the great comments. Are definitely very, very insightful. So just to try to reply to some of your points and also to the ones that Jay just mentioned. So of course, this crisis is quite different from what we have seen in the past. So first and foremost, the key variant is that is public health care. So its cause is basically truly exogenous, rather than, as in the previous downturns, stemming from, I don't know, an endogenous system of failure, such as the excess supply or excessive financial imbalances. So in addition to this, several factors also provide the support for the fact that the real estate performance will be different this time around. So the COVID, in particular in terms of rebounding. So the COVID-19, for example, was hitting when interest rates were already very low. So meaning that there was already no lag between a drop in the sentiment and basically the policy support being in place. So policy action in general was overall very swifter, more sizable, and also much better coordinated than what happened in 2008 and 2009. So second, another element that seems to point to lower losses than what has happened in the past is that the leverage also for the past cycle was quite low. So meaning that investors in general had a better capital buffer now than they did instead in the early stages of the global financial crisis. So the third is that also, for example, supply growth is much more contained than in the past. And those are all points that seems to hint that there will be less losses, of course, than what you see with the GFC. Having said that, there is still much uncertainty as to how the kind of crisis will actually fully play out. So an effect, in particular, because an effect on real estate in general tends to lag wider financial market sentiment. And in particular, because also real estate cash flows is set also to remain under pressures in the near term. There are still, at least for some countries, still some physical barriers in forms of travel restrictions and also physical distancing requirements, for example. So the key aspect to see exactly that could contribute to possible further pressures down the road that might be element for financial stability risk assessment is that, as Anthony was pointing out, is that there will be a divergence of rental growth performance, which is set to remain high, at least for the time being. So restrictions, as I said, also will remain in place for some countries, which will wait, of course, on the prospect of a swift recovery, for example, in the activity in 2021, as well as all the discussions about the structural change seems to be reflected in increasing office vacancy rates. So there will be definitely different experiences both across countries and within countries which are still surrounded by much of uncertainty, but are definitely deserving still monitoring from a policymaking point of view. Just briefly, maybe on the policy recommendations. So of course, what we want to try to convey with our policy recommendation is that these, of course, they have to be implemented under certain circumstances. So what we notice that now we are in an environment where policy support has been very sizable with very low interest rates, but which helped, of course, to maintain easy financial conditions and also the flow of credit to many firms. But the drawback is that easy financial conditions could also contribute to excessive risk-taking going forward. Fully, for example, the increase in financial vulnerabilities and also the persistent in certain areas or in certain segments of the CRE sector of misalignments. So that's why what policymakers should focus on are targeted macroprudential policy tools, and in this specific case of limits, for example, loan to value and debt service coverage ratios. But the key takeaway is that the optimal timing as well as the type of policy action should, of course, also depend on the country-specific pace of the recovery, as well as the degree of pre-existing financial vulnerabilities, keeping in mind also at the same time the fact that there might be potential lags between implementations and the full impact also of calling an early action. I will stop here.
Great, thank you. Unfortunately, I think we're out of time, so I don't think we can go much farther. But that was a terrific discussion of a pretty complicated and really important topic. I want to thank the IMF team for bringing their terrific work to us, and in particular, thank Wenxin and Tony for really insightful comments and stepping in to provide those. That really makes the event happen. So thanks to everyone for joining us, and please stay tuned for further events like this one or in our other series.